Good Thursday morning, Market Chameleons, and everyone join us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor. Call your broker dealer. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
All right.
And we look with that. I'm going to share my screen. If anyone is joining us for the first time, Will and I, we do this show in the mornings to help answer questions you may have about the Market Chameleon tools, the data or analytics. So if you want to come on a show and ask a question, you can come on the show live. We have a link to Zoom on the live chat on YouTube. Click on that, come over to Zoom, click on raise your hand. That lets us know you want to ask a question. Once we let you in, you could ask your question live. If you prefer to type your question, you can do that into that live chat on YouTube. In that box, Will's watching it, he'll read it back to me. In the meantime, while we're waiting for more people to join us and questions to queue up, we'll take a look at the pre-market report, see what's trading in the pre-market hours, get some insights. A couple other things on the agenda. We had to push out some new features probably a little bit earlier than I wanted to for several reasons, because of things that we're doing in the background. And I might mention them today because you might see them kind of, in different spots on the website. We are still enhancing those features, but we had to do a publish last night for a different reason. So they did come out. And if you're navigating around the website, you'll probably see them. I'm going to mention a couple of them today. And we had some questions left over from yesterday. I'm going to try to get to that as well regarding interactive charts around earnings and earnings moves.
Yeah, it did occur to me, I think it was Michael McCrae who asked that question, D, and he was asking, I think maybe can he adjust the standard deviation? If he comes on, I'll ask him to remember what he was asking about it, but I think he was asking about this standard, more than a one standard deviation move or something.
Okay.
All right. Cool.
Yep. So let's start out with the pre-market report. And these are stocks right now trading in the pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 89 stocks made our percentage gainers list, 53 on the decliners. So right now, from that perspective, we're looking like we're setting up for a bullish bias at the open. But if you look at it, you could see, if you look at this list, you'll see that there are small cap stocks in their ETFs, leverage products, any security that's listed on a major U.S. exchange that's trading in pre-market hours and meets our thresholds, it can make this list. And what we want to do is narrow down this list or filter it down to a smaller group of stocks to get more insights. And to do that, we could use the filters here above. And let me slide over. And by the way, I think this just came out yesterday. Do we have this feature out before? I'm not sure. So I'm going to mention it really quickly before I use that filter. So here, what we see is these here are pre-market. This is the pre-market report for previous days. And we did have this because we get a request of going back days or going back to a certain date. So you can use this calendar to go back, to a certain date. Let me X out of it for now. Keep it here. All right, hold on. How do I? There we go. But I'm going to keep it on today's date. And this shows us basically the amount of stocks trading in pre-market hours that are up, amount of stocks that are down, these are looking at all the stocks. This is the total volume of stock in the stocks that are up, total volume in the stocks that are down. So 499 stocks are up versus 242 down. So it doesn't matter even if it trades 1 share, 2 shares, doesn't really have to meet any threshold. This is just, aggregating everything. And this is the total dollar volume of all the stocks that are down, total dollar volume, stocks that are, up versus down. So you could see here, more than 2 times in dollar volume up and down in a pre-market relative to yesterday's close. And you could kind of go back and see how the other days ended up, right? Okay, so if you wanted to click on it, it'll take you here. Let me try it really quickly. So I clicked on April 26th. It's going back right now. And now it reloaded the April 26th report. Okay. So let me come back to April 27th. Again, you will see enhancements probably on other parts of the website that we did have to push out. Let's take the pre-market report, today's, and let's filter down these, the securities in this list. And I'm going to use the filters above. Let's use this one in ETF. Click on that. You get a drop down list. And when you select one of these items, and it's a different ETFs, some of them are sector ETFs, some are broad-based. When you select that ETF, the stocks in the list below will get filtered by holdings in that ETF. So SPY, that's the broad-based S&P 500 ETF. Let's click on that. And the list below, will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we see 18 stocks made our percentage gainers list, 12 in the decliners. So from this perspective, we're looking like we're setting up for a more bullish bias at the open, slightly bullish from that, looking at that. Let me get to, so Meta, that's the big one, just reported earnings. And they're up 14% in the pre-market hours. They're talking about AI, artificial intelligence. People are obviously excited about that part of it. But I'm going to use Meta as an example to come back to a question I think we had from yesterday regarding earnings moves. Right, so this is Meta up 14%. That's reacting to earnings. And I'm going to come down here under earnings interactive charts. And I'm using this because we also had to update this. So this is going to look different than you're used to. And over here, we created different reports that are giving insights into Meta's stock behavior around earnings. And a lot of people, what they'll do is use the option straddle as the market's prediction for the earnings move. So if you look at the earnings move, what were the options predicting the day before, up or down, right? So options are if you buy straddle, buying a call, buying a put, the stock has to move by a big enough percentage to cover the cost of both. So that's the straddle's prediction of the stock move. And then we compare that to the actual move the next day after the company reports earnings. So wanted to point a couple things out when we look at this report. And right now, this is going back and giving us a summary, right? This is giving us a historical summary of what the options predicted prior to earnings. So it's looking at the average prediction prior to earnings, right? And if we took the average of all our history, the prediction was 6.9%. So the straddle predicted on average 6.9%. Well, how does that compare to the actual earnings move? So the actual earnings move in the same period was 7.5%. So you could see that historically, the options underestimated Meta's actual earnings move by about 0.6%. So on average, they underpriced the actual move. Okay, so that's the move for the entire day. What about the initial gap? In other words, right now, the initial gap, we don't know where the stock will be by the end of the day, right? Because that remains to be seen. But the initial gap is where is it going to open around? That first minute, that's where we measure the first minute VWAP. So let's say, if it were open, it would be for 14%, right? That's what the initial opening gap. So on average, that initial opening gap averaged 7.2%. Again, what is that telling us? That the options markets in the long term underestimated the actual earnings. All right. This is the intraday drift. By the way, if you click on one of these, it will take you to a more detailed report, which you could click on here. But let's go over the summary first. So when we see the market's going to open, right? Wherever it opens, right now if our guess is if it opens around here, it's gapping 14%. It opens 239. Once it opens, more traders come in. There's more liquidity from VWAPs and all sorts of strategies. So what kind of move do we expect between the opening and the close, right? So that this move, once it opens, that move's already in there. How much more do we expect this to move after the open? Do we get another 10% move, 5% move, 1% move? Is it going to remain at this price? And that's the drift we call from the open to the close. So from the open to the close, the average drift was 1.7%. So you could see most of the move is at the opening gap, and then intraday on average moves up or down 1.7%. So now we're getting an idea of the potential ranges of Meta. And we could close, once we click on that, here, I'll just show you. If you click on that, it'll give you more stats on the open to close. So I'm going to come back to that, but let's stay on the summary.
Hey, D.
Yeah.
When you're ready, Michael is in the waiting room and he wants to come on and ask a question about this chart. So we can wait till you're done, or
okay. Yeah, we could let him in. If he is waiting, let him in. Yep.
All right, Michael, you're coming in. Thanks. Turn off your mic, mute, Mike.
Hey, Mike. Yeah, you're on mute. So.
Okay, I got it. Can you hear me now?
Hey, Mike. Yep. How's it going?
Perfect. Thanks for coming in, Michael. And so everyone knows, Michael asked a question about the interactive charts yesterday. And it's nice enough to come on and dig deeper into the question he had. Thank you so much, Michael.
Thank you for having me.
Thanks.
As for some reason, I don't see the interactive charts loading. This is where I go, and I normally see the over and under chart. The under and over pie chart on this page.
Yeah. So if you're listening, what we did was we updated this page to fit more basically analytics, a wider and give you like a nicer scope. So yeah, so this page is different than you used to seeing the previous. So we did make an update to it.
So this is just so everyone knows, this page changed overnight, right? So the question Michael had yesterday, there may be a different way to find it, Michael.
Right. So you're looking maybe like at this pie chart, but what we did with this page was, and I'll go over it, but we created it so we could add insights, kind of help you navigate this page of what this table is, what kind of questions it's trying to answer. We also put in more descriptions about each page, so if you click on it, you'll read more descriptions. So the previous page was just a table with numbers. And, because I get a lot of questions trying to get explanations about these tables, that's what we did was instead of scrolling down and seeing this one over the other, we put it on tabs and added explanations and insights that you could draw from these graphs.
Okay. So my question was, as you know from our past discussions, I do the earnings strangles, and I know that this defaults to either, is it one standard deviation or a straddle move, I think, in terms of over and under percentages.
Yeah, so it looks at the straddle move, right? So it says, here's a straddle, right? This is the predicted move, according to the option prices, and that's what this defaults to.
Right. So the question became, it would be nice, it's kind of a nice to have, not must have, but just be able to have some flexibility because I go farther out of the money, and just to be able to see what the percentages would be going out to 2 or 3 standard deviations. I know there's probably could be a big adjustment to make, but just something that would be nice to have, not must have. I mean, I get, I manually basically off the, I look on toss, I look at the expected plus or minus dollar move, and then usually multiply that times 3 to see what the two standard deviation and 3 standard deviation moves are. But I know that they would be probably be, they would overestimate it even on a higher percentage basis going farther out. But that was kind of the question I had. Do you understand what I'm asking?
I mean, I'm assuming, let me just go to the options chain. You're saying if you're looking at the options chain, you want to see which strikes are if you took the straddle, let's say 7%, and you doubled it, which strikes would it hit? Is that
No. What the over and under would be based upon historical patterns. If let's say I go out 2 standard deviations, right? What would the over and under percentages be on that pie chart? Because right now you have it on a straddle, which is essentially, 1 standard deviation approximately, right? The straddle move approximates 1 standard deviation, plus or minus. It's close enough to government form. But if you could put in an input so that you could see what that over and under would be if it was 2 standard deviations, or 3.
Over under would be with 2 I mean, I'm not sure.
Well, like given like looking at the history of the movement of the stock, I mean, instead of looking at 1 standard deviation or a straddle, it would look out further to see how many times it hit a 2 standard deviation move, whether it was over, how many times it was overestimated or underestimated, going farther out probability curve. Because you're basically doing it at 1 standard deviation. I mean, it's a straddle, but that's roughly 1 standard deviation, right?
Right. That would be the if you're looking at the implied volatilities, right? So you would say that there would be a 1 standard deviation move, but in the earnings gap, it's not quite the same when you look at option prices and you take option prices and you put them through a option pricing model like the Black-Scholes, right? The Black-Scholes option pricing model, that's the world you're looking at. It's standard deviation moves. So this is correct is when you're talking in terms of, implied volatility. The thing is that a gap move like earnings, when you're looking at earnings do not move at a normal distribution. So when we're talking about standard deviations, right, we're talking about like normal distribution curves and stuff like that. Well, earnings don't move that way, right? So earnings, you can think of it in terms of the Black-Scholes model and a normal distribution, right? So I think I know what you're saying about like one standard deviation and what a straddle implies, because according to the Black-Scholes model, where a stock will move at a normal distribution, meaning that, if we close, what's a normal distribution? Meta closed at 209.40. So normal distribution assumes that the stock's probability of hitting 209.41 is much higher than hitting 209.42, and which is higher than hitting 209.43, right? It's because it has to trade at that price before it gets to the next. But we see that in earnings, right? The earnings itself does not behave that way, right? You could see it just went, we're up 14%. Here's the close, 209.40. It's already 239.44. So when we talk about like a option pricing model that does price things in terms of, like you're saying, standard deviations, it doesn't do that in a gap environment or earnings environment, because the Black-Scholes is not a perfect model. It's just kind of a model that right now is the best model just to kind of apply it across the board, right? So if you had to create a model that you could just kind of apply across the board without tweaks, then the Black-Scholes model is like the best that we have. But as far as like, if we're talking about earnings, your standard deviations of 1 or 2, it's not, you wouldn't be able to use the classic that type of an analysis.
Yeah, but you're looking at values before the gap happens. I mean, this straddle move, does it already take into account elevated implied volatility because of the earnings? I mean, you don't know, you don't know, what the move's going to be, but that calculation is based upon the fact that, the implied volatility is elevated, right?
Absolutely not, because when we're talking about, you got to go look at the Black-Scholes model. If you look at the Black-Scholes model, right? If you look at the Black-Scholes model, when we talk about implied volatility, there's an underlying assumption, right? And the underlying assumption is that the stock will move at a normal distribution. It has to be clear.
Which is kind of my point. So you should be able to plug in a 2 or 3 standard deviation based upon the normal distribution, right?
No, because during earnings, a stock gaps. You see, this is not a normal distribution. We're looking at Meta right now. Does that look to you like a normal distribution move?
Well, did the straddle move prior to that move predict the gaps was going to happen? No, it looked at the, it looked at the, does it account? It accounts for the elevated implied volatility. No,
because when you're looking at options, right? I could calculate implied volatility for anything, right? But is it an appropriate model to use around earnings? So when we're looking at the implied volatility, you're referencing implied volatility. But what I'm saying is around earnings, it's not an appropriate model to use. You could forget about the Black-Scholes model completely around earnings, because it wasn't created for gap moves. It wasn't created for earnings. like according to Black-Scholes, earnings don't even exist. Earnings moves don't exist. Okay, so the Black-Scholes model says that in the real world, a stock cannot close at 209.40 and open at 241.40 the next day. That assumption says that cannot happen. And because of that assumption, the Black-Scholes, you're referencing the Black-Scholes model where it wouldn't be even useful in this situation.
Then what's the use of using the straddle prediction on the move then? I mean, isn't the straddle?
The straddle is letting us know, right, what the options are pricing the move. So the straddle itself, you could work backwards and get the implied move, right? But we're not referencing any more the implied volatility. We're looking at the implied move. So what we're doing is extracting what is the implied move in the stock.
And then you can compare those moves to other earnings moves, correct?
Exactly. So what we're doing is extracting the implied move, not the implied volatility.
Well, that's what I get. Right, exactly. That's exactly right. And so that's at the straddle, but at 2 standard deviation, there's also an associated implied move. Like if at the straddle, the up and down price move is $5, at 2 standard deviations, right? It's going to be a different value, but there's still a value there. There's still a value there because you're basically translating the straddle.
So you're saying just double the straddle.
Move.
Yeah, no, what Michael, I think Michael, what you're saying is like if you're gonna look out, you want to price it like 3 straddle moves, right? It's not exactly it.
Huh?
You would want to go out 3 straddle. Like if I was gonna make, what's the chance of a 3 strat, like how moving 3 times the straddle?
How did it move in the past based upon a 3 straddle move or a 2 straddle move as an over and under versus a 1 straddle move over and under?
By over under, you mean how many times has it happened in the data?
Well, I looked at the pie chart, right? And just keeping it simple, at a straddle move on Meta, scroll down to that chart again, the interactive chart.
Okay, like you mean this one?
Pie chart. So in the past, 12 times, or how many times it goes back, I don't know. But in the past, based upon a straddle move, it overestimated at 57.9 times, correct?
Right.
So extrapolating that to a 2 straddle move, what's happened over that same period of time? How many times it would be higher, right?
Right. So 57.9%, it would be higher. The actual move was higher than the implied move. Yes.
Yeah. Right. So I was my question became it would be kind of interesting to see based upon a 2 straddle move what that pie chart would look like, right? Or a 3 straddle move.
So you mean like how many
like
times
how often do the wings come into play is what you're asking, right? Like how often does it trade down?
I'm just extending that pie chart instead of 1 straddle to 2 straddle. Keep it simple. How many times it was over? How many times did it hit a 2 straddle move? This is telling you how many times, the prediction versus the actual, right?
Yes.
Is that right? So
yes.
So that was kind of what the question. I know it's probably a lot of adjustments that would have to be made to see that, but that's basically what my question was. Because like I said, I go farther out, and it'd be just interesting to see
I think what you're trying to see, and what you're trying to see is, well, if you did a strangle, right? If you did a strangle that wasn't at the money, but if you did, I think now I'm understanding what you're trying to say.
Yeah.
If you did a strangle and you decided to do the strangle with strikes that were 2 times further away than what the straddle
exactly exactly.
And what you would want to see is, well, how many times did, what was the average return of those? Basically, you wanted to see if I did that every time.
What the over and under was. Yeah. What, just based upon your historical data that you use now, because that's going back far enough. So you're right. That's what it is. That's
right. So I think, right. So you're looking at, well, if the straddle was, $5 and I went out $10 and, sold a put, sold a call, what would,
what would that pie chart look like?
What would this pie chart look like? Okay. All right.
Yeah.
I think I understand now what you're saying. Right. Well, this tool won't do that. That would be like a different, what I'm saying is right now you can't do that.
D, wouldn't you be able to find that if you, I know Michael wants an easy snapshot, but if you go in and do, look at go put the trade together, you could then look at the data, right?
So look, a really quick way to get an estimate of that is the following. I could take that on average, the straddle was pricing in, let's say 7%. If we went to the actual earnings moves over here, these are the actual earnings moves, right? And we could see, on average, they move 7.5%. But what we want to know is like, how often, if we doubled it to 14%, right? How often did it go past it? So right here, click in here, 14%, right? Calculate it. And 79% of the time of all our observations, the stock moved less than 79%. That means 21% of the time it moved higher.
Okay. All right.
That's one quick way to do it. That would kind of give you what, the percentage of times below, percentage times above. So if we put in 14%, 21% of these observations up here were higher. So let's say we wanted to do 20%. So 92% of the time, Meta, from all the history going back to 2014, moved less than 20%. That means 8% of the time it moved beyond that. So it's kind of like a quick,
so does that figure, is that the percentage move off the close of the stock before the earnings are reported? Because I could back into it that way.
Yes, it's the closing price before.
Right. So I could take the 3 standard deviation point-wise, calculate what the difference is between that and the closing price, and plug that into this, and that would do it.
And that will give you the percentage below. So exactly.
Okay.
So you would be able to do it that way, which is kind of like a quick estimate. It won't give you like as detailed as the other reports, but it'll give you a quick estimate. Like, okay. And by the way, you could change this also to number of years and quarters. So if you're saying, I just want to see for the first quarter, right? So now for the first quarter, 100% were below 20%, or if you want to do it like, just show me the last 4 years, it will also show you. So you can narrow down this data.
Okay.
But I'll come back to, it's a good question. Maybe I just didn't understand it, the way.
Listen, Michael, if you play around with it today, because obviously the chart's different than yesterday, and this was just by chance. Dimitri loaded a new version overnight. So it'd be good to hit it tomorrow. We did have a question from Swami as well, which I'll send over to you, D, about what is the value of looking at something that's overestimated and how would you maybe react to it. But anyways, the bell went off 5 minutes ago. Thanks for coming in, Michael. If you want to join us tomorrow, just shoot me an email or text me, whatever.
Yeah, thanks a lot. I didn't mean to take all your time.
No, it was awesome.
I'm going to
Dude,
play
I
around.
wish everyone came on every day. It would,
it takes a great person to come on a show for sure.
Yeah, no, it was a great question. And anything we can do to help you in your trade, and Michael, we try to do. So great job, Michael.
I'm going to play around with it for Amazon coming tonight. We'll see what happens.
Awesome. Okay. Great job, Michael. Have a good day.
Guys.
Thanks, Mike.
All right, Dima. Great job. Love the new features. Thanks.
All right, everyone. Thanks for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trading